Hello friends, welcome back. Are you like the many who are stuck in a hard spot where your investments are stagnating? As all of us know, fixed deposit rates have hit the rock bottom. Gold is not easy to handle, and real estate is very volatile. And have you considered the stock market? The first question that comes to your mind is, how do I go about investing in the stock market? Isn't that volatile too? I will teach you the wisdom of Jack Bogle, the guru few have heard about, but one that many follow secretly. So friends, let's just dive into it. If you do not invest the next 45 minutes in this video, you are assured to remain stuck where you are, which is the sea of poor returns. So friends, in this video, I will give you that secret mantra, which is the rising tide will lift all the boats. But what will you do if you do not have a boat? This video is about building the boat. I used to think that in order to grow my investments in the stock market, I'll have to know about fundamental analysis, technical analysis, understand economics, get a hang of profit outlook and other mathematics, and read a whole load of books. That was a very overwhelming task until I discovered that markets are driven by sentiments. No one wants to buy a car made by Tata Motors, but all would love to buy shares of Tata Motors. This is how sentiment works in the market. It is time that you stop feeling overwhelmed with the poor returns that I mentioned in the earlier slide. Now it's time to reap the benefit of riding the wave or doing the surf riding on the stock market successfully and without losing out. Following a roller coaster ride through my investments and not finding the growth or a guaranteed growth that I wanted, I was quite disappointed. But when I searched, I did find a guru, and he taught me how to overcome the situation and navigate through the fog. What I'm going to tell you in this video are the tricks learned from the champion of the common investor. And that champion of the common investor is John Bogle, better known as Jack Bogle. As the CNBC headline here on the screen states, his investment strategy never changed. And he developed his strategy in 1975, and he passed away in 2019 at the age of 90. At the age of 67, he had a heart transplant, but he went on to the age of 90 to produce excellent results for every common investor, something that you can replicate for yourself. Jack Bogle was an investment banker, and he launched the world's first index-based mutual fund called Vanguard way back in 1975. In 1975, the assets under management of this company were only $180 billion. In 2021, that rose to $7.5 trillion. That is giving a consistent annual growth rate, or a CAGR, equal to 8.5% for 46 years straight. But let us first see how much is $7.5 trillion US dollars. If we compare it to the GDP of some of the advanced nations, here are the figures. The GDP for Japan stands at $4.87 trillion, which is just a little under 2/3 of Vanguard's assets under management. Germany stands at 3.69 trillion, followed by India at 2.65, with Britain just a notch lower at 2.63, followed closely by France at 2.58 trillion US dollars. If you put together the figures for India, Britain and France, they will be just a little over what Jack Bogle has been able to give his investors over the course of time. You too can build your assets and grow at that rate, and I will teach you how. Here is what Arthur Levitt, the former chairman of the US Securities and Exchange Commission, has to say about Jack Bogle in his book Take on the Street. What Arthur Levitt states is, Jack Bogle has given investors throughout the world more wisdom and good financial judgment than any other person in the history of markets. This video is based on knowledge shared by Jack Bogle in his little book called The Little Book of Common Sense Investing. The subtitle of this book is The Only Way to Guarantee Your Fair Share of the Stock Market Returns. And this book does help you to achieve exactly that. Let us now see how the stock market has fared in India over the past 20 years. It has grown from 3,353 on 14 December 2001 to 57,215 on the 17th of December 2021. That is this year. That is a mind-boggling 1,706% growth. Let us now look at the performance of the Sensex over the last 20 years with a more familiar metric, which is the compound annual growth rate, or CAGR. Here is the formula which uses the final value and the starting value for the time period that we are looking at. We are looking at 20 years. The CAGR for that period of 20 years works out to 15.24%, 15.25%, consistently every year, growing on and on, if you remain invested for that period. Let us now compare this with the highest return on fixed deposits in banks. This data is from the Reserve Bank of India. And as you can see in these two tables, the highest percentage of return on fixed deposit is 9%, and the lowest goes down as low as 5.55, as we'll see in the next chart. This is a continuation of the Reserve Bank of India data from the year 2011 all the way up to the current year 2021. As you can see that there's a steady decline from 9.25 all the way coming down to just a little over 5.5%. Just use these figures to compare with the performance of the stock market, which is 15.24 or 15.25% consistently for 20 years. Another favorite investment destination for people is gold. As a matter of fact, JP Morgan, the founder of JP Morgan and Company, said gold and silver is real money. Everything else is only credit. So how does an investment in gold fare as compared to the fixed deposits and the stock market? Let us see that in the next slide. Here is how gold fared for the Indian investor over a 20-year period. If you look at the highest and the lowest value during this period, you will find that there has been a rise at some point of time equal to 930%. But let us calculate the CAGR for a 20-year period from 14 December 2001 to 17 December 2021. If we do this calculation, the CAGR works out to only 11.55%. That is 3.69% lower than the Sensex. In other words, if you had invested 20 lakh 20 years ago, you would be a little over 20 lakh rupees poorer than if you had invested in the Sensex for the same period of time. In other words, you would have lost the equivalent of your initial investment over a 20-year period when comparing the gold returns in comparison to the Sensex. Let us now take a look at the real estate scenario in India. This used to be another hot favorite for the Indian investor. What you see on the screen is a plot of the real estate in India for the last 10 years, and it speaks for itself. The line in red is the nominal value, which means the actual cash that you would get in hand by selling some property. And the line in blue depicts the return after adjusting for inflation. Since the year 2018, much before COVID-19 times, it has actually gone below zero. During the initial 5-year period between 2010 to the first quarter of 2020, the average property prices increased by a mere 5 to 7% year on year, but thereafter it came in the range of 0 to 2%. This does not take into account the amount of money that is paid for brokerage, maintaining the property, paying the taxes on that, and what is more is finding the right customer in the right time frame. You cannot sell bits and pieces of the property. You have to sell the entire property. Whereas if you are in the stock market, you can sell stock in any numbers that you require. You could decrease or increase your portfolio holding with just one share. That is entirely up to you. Another disadvantage of real estate investment is the price variation in a similar property. A flat in the same building but on a different floor will fetch a different value. The direction in which the door or the balcony or the windows face will also determine a variation in price. So you have to take into consideration before you consider comparing it with the stock market, the fixed deposit, or gold. We talked about the champion of the common man investor at the beginning, and his name is Jack Bogle. Let us see some fundamental principles which Bogle enunciated, 5 of which are extremely important. First one is the time is your friend. Start early. It's never too late. And the beauty of investing in the stock market is you can start with a very low number. It's not a percentage or a fraction of the cost of an asset, or similarly with gold. Stick to what you have invested. Stay put. Time is your friend. So you must stick to a plan. Ignore the chatter of the day. You will find many of your friends who are sitting glued to the television or to the ticker tape of the stock exchange, and they are taking tips from so-called experts. None of these fund managers have been able to give a consistent result for more than 3 years in a row, after which the fund manager or the advisor changes. Let miracle of compounding work for you. We saw in the example that the difference in the CAGR between gold and stock market over a course of 20 years actually cost you the amount that you invested 20 years ago. The next important thing is buy right and hold tight. What exactly we mean by that is set yourself a target of your asset allocation. We shall talk about that a little while later. Ignore moves in the market. There'll be some days when there'll be a massive jump. Some days there could be a crash. But since you're a long-term player and time is on your side and time is your friend, don't let the moves in the market bother you. You are going to be a passive witness to the growth in your assets. You simply don't have to do any work except planning what kind of a portfolio you're going to build. And that's exactly what I'm going to teach you. By the end of this video, you will have learned the tricks which Bogle wanted us to understand. Stick to that plan. Once the plan is made, commit yourself to following Bogle's plan. All of us are familiar with the idiom, finding a needle in the haystack. Do not chase single stocks which promise to give great returns. You are not a trader. You are an investor. Your first duty is to protect the capital. Your next duty is to get the best return possible safely. So don't go after the needle. What all these experts are commenting in the columns of newspapers or giving tips on the television are just about some needles in the haystack. Instead of that, what Bogle is asking us to do is to buy the entire haystack. Cut your risk by purchasing a broad-based, index-oriented portfolio. And this video is going to teach you just that. Bogle also used to love using the analogy of the fox and the hedgehog. Foxes are sly and they represent financial institutions that sell complicated products. They charge a high fees for this advice. Me as an investor, I'm not interested in paying for the salaries and bonuses of these so-called experts. I can achieve that by being a hedgehog. Whenever a hedgehog is threatened, all it does is curl up into a spiny ball. It is a simple and yet very effective strategy, not only to protect your investment, but to get the highest possible returns, which we have discussed at the beginning of this video. You could invest in many growth-oriented mutual funds. What Jack Bogle found was that none of them gave you the consistent results that his strategy provides. Mutual funds lose out to Bogle simply because they have an entry load, an exit load, and they pass on all their transaction costs to you. Further, you do not earn any dividend on the stock or shares which they buy to run the mutual fund. Did you know that the Indian mutual funds have the highest expense ratio in the whole world? As a matter of fact, Indian mutual funds have an average expense ratio close to 1.78%. That speaks for itself and supports the case why we should follow my guru, Mr. Jack Bogle. What is important is you stay on course. Don't be a butterfly flying from one flower to another. Do not fall for the advice that you hear on TV programs or newspaper columns. Remember, stock picking does not work. So do not go for the so-called tips from the so-called experts. Fine-tune your holdings and stick to it. And that's what we are going to learn in this video. This way, you're not going to incur any unnecessary costs or undertake any unnecessary risks. The trick, according to Jack Bogle, is to invest so that your portfolio replicates the performance of the index that you choose. There are many indices to choose from. Your portfolio, which I'll teach how to construct, will simply follow the index that you choose. The remaining part of this video will explain how you can do it yourself. Before we proceed any further, I would like you to know some terms that are used in the stock market. Not complicated stuff, nice to know, and once you master the technique, you need not even remember the definition of these terms. Businesses raise money by issuing shares. When a company is formed, the company sets out a target of the share capital that it can raise. The term authorized shares refers to the largest number of shares that a single corporation can issue. The number of authorized shares per company is assessed at the company's time of creation, and after that it can only be increased or decreased through a vote by the shareholders. The next term that we need to understand is the term called outstanding shares. Outstanding shares refers to the number of shares that a company has issued. In other words, money has been paid for these shares. Outstanding shares are further subdivided or classified into two categories: restricted shares and free float shares. Restricted shares are those that are held by the promoters, financiers, directors, affiliates, and banks. And these cannot be sold or traded unless some preset conditions are met. So what is available for trading in the market that you and I could instruct our broker to buy on our behalf are what are known as the free float shares. These are the shares that can be publicly traded and are not restricted, like the restricted shares. The next important term that you and I should know is market capitalization. The formula for calculating this number is to multiply the price of the share at a given moment by the total number of outstanding shares. This includes restricted and free float shares taken together. So total number of outstanding shares multiplied by the current market price of a share is the market capitalization for that stock. What follows from the previous definition is the term free float market cap or market capitalization. This is the market cap of the tradable shares, which we have seen are also known as the free float shares. It equals the share price multiplied by the total number of free float shares available for the company. Let us take an example to understand these terms. This is the data for Nestle India from the Ministry of Corporate Affairs website. The total authorized capital is rupees 100 crores. The paid up capital, that is the capital raised from the outstanding shares, is a little over 96 crore rupees. Each share has a face value of rupees 10. Let us continue with our example for Nestle. As we have seen, this is the value for the paid up capital. That means this is the value of the outstanding shares when the shares were issued at a face value of 10 rupees. If we divide the first number by the second, that means A divided by B, this gives us the total number of outstanding shares. The market price for the share today, or at the time when this presentation was prepared, was 19,178 rupees. So it means that the total market cap is 1,84,626 crore rupees. This is simply multiplying C by D, and you get this number. Now let us look at the data on the Bombay Stock Exchange website. This data is updated live when the trading session is open. Here is a snapshot when this presentation was made. The share price is shown in this box here. This box shown in blue is the market cap for all outstanding shares. That means the full market cap. And what you see in this red box here is the free float market cap. The data in the red boxes will be used by you every time that you invest. So now I think you must be very clear about what is meant by free float market cap. The share price, the free float market cap, will be the only data that you will be requiring for doing all your calculations, and we shall see how. Before we build your portfolio, you must understand the basics of Sensex. The word Sensex is formed by combining the words sensitive index. The 30 largest and most actively traded stocks are part of the Sensex. Whatever information is provided here also applies for the Nifty 50 and for all other indices. But for now, we shall stay with the Sensex because it is a simpler way to form your concepts right. These companies are large to mega cap stocks. They are all the blue chip companies and the biggest of them. The other requirement for being part of the Sensex is that they must be relatively liquid stocks. That means they are easily tradable and they are traded regularly. And the next condition is that their revenue must be generated from their core activities as declared in their Memorandum of Understanding with the Ministry of Corporate Affairs. For now, this much information will suffice. By now you must have realized that the Sensex is a very dynamic number because the Bombay Stock Exchange reconstitutes the index every 6 months in the month of June and December. Tata Power dropped out in June 2015, as did Tata Motors, which dropped out in December 2019. Wipro dropped out in December 2018, and recently in December 2021, it was back in the Sensex again. Nestle joined as late as December 2019. Otherwise, it did not figure in the Sensex at all. Similarly, when Wipro came back to the Sensex, Bajaj Auto dropped out in the same time. That is December 2021. So once you have done the initial work, after that spade work, you will need to update your table and your calculations every 6 months. But I assure you, it won't take you longer than an hour and a half to 2 hours, which is a very small investment of time for the profits that you're going to earn. As we mentioned a little while ago, the Sensex consists of 30 constituents. And I will now introduce another important term, which is the weight of each constituent. The weight of a constituent is proportional to the free float market cap. And we shall see how in the next slide. The concept of the weight of each company in an index is best understood with a simple example. Suppose we have to invest 10 lakh rupees in 3 companies. These 3 companies are the constituents of a hypothetical index. Let's see how we go about it. We first construct a table. This table has 4 columns. The first column lists the 3 companies. These companies are ABC, BCD, and PQR. The next column is the free float market cap of each company at the moment when you are investing. This has been designated as number X. And as you can see, the free float market cap for the first company is 50,000. For the second company is 15,000, and for the third company it is 35,000. All this adds up to 1 lakh or 100,000. The next thing is to calculate the weight of each company in the index. Weight always refers to the weight of the company in the index in terms of the free float market cap. So as we can see, if we divide 50,000 by 100,000, the weightage of company ABC is 50%. That of BCD is 15%, and that of PQR is 35%. Now, as we mentioned earlier, suppose we were to invest 10 lakh rupees. In that case, the distribution of my capital of 10 lakh rupees will be in proportion to the weightage of each of these constituents of the hypothetical index. Thus, ABC, I will invest 50% of my 10 lakhs, which is 5 lakh rupees. BCD gets 15% and PQR gets 35%. You must understand this concept very clearly because this is the linchpin of the Bogle method and is the secret of growth of the Vanguard Trust. It has risen from $180 billion to $7.5 trillion of assets under management. You can review this slide a second time just to get the concept very clear. Here is what you have to do. You have to add all the free float market caps of all the constituents. Then divide each company's free float market cap by the total market cap. The total market cap was Y, 100,000, and the free float market cap of each company is under column X. I'm repeating this so that it is very clear. Let us now see how we will divide our money in the 3 different shares. This is really quite simple. All we need is one more input, which is the price of share of each company. So these are the new columns. We have the stock, which we already know, the weight, which we have determined, the investment per scrip, which depends upon the weightage, and the total portfolio value that we want to set up. The new thing in this chart is the share price. Let us assume that these are the share prices. ABC, each share is 20 rupees. BCD, each share is 1,500. And PQR, each share is 700. Now all I have to do is divide column F by G. That means the investment per scrip to be divided by the share price. This gives me how many shares I need to buy. That's all. It's as simple as that. This is how your portfolio will look like. To summarize, you have decided to invest 10 lakh rupees in 3 companies which constitute a hypothetical index. According to that, we should be investing 5 lakhs in the first company, 1,50,000 in the second company, and 3.5 lakhs in the third company. The total number of shares to be purchased will be determined by the investment value, which is shown in the last column, divided by the price, which is shown in the second column. That tells us how many shares of each will be purchased to build our portfolio. Now you're done. Having set up a portfolio based upon the weightage of each constituent of the index, we have now set our investment portfolio on autopilot. It will simply be tracking the index, and we shall see how. Say the index when you invested your 10 lakh rupees was at 12,345. For this invested value, all you have to do is sit back and watch the index rise or fall. Suppose the index rises to 15,000. What do you think would be the value of this portfolio? Let us see the calculation in the next slide. As we said that when we invested 10 lakh rupees, the hypothetical index of 3 companies was 1, 2, 3, 4, 5. Then we said that the index rose to 15,000. Then my portfolio value will be 10 lakhs divided by 1, 2, 3, 4, 5 multiplied by 15,000. That comes to 12 lakh 15,000 rupees. Now remember one thing. If you look at this number, 10 lakh divided by 1, 2, 3, 4, 5, it works out to 81. This is one number you ought to remember, because what you are going to do is whenever you watch how the stock is moving or the index is moving, all you ought to do is multiply that number by 81 and you will instantly know the worth of your portfolio. Let's take another example. If the index were to rise to 20,000, my portfolio would be worth 20,000 multiplied by 81, which works out to 16 lakhs and 20,000 rupees. So now friends, it's time to roll up your sleeves and dive into the practical part of it. Here is your do-it-yourself kit. First of all, you must have access and some competence in using the Excel sheet. When I say basic skill level, it just includes data entry, that means entering words and numbers and adding them up and dividing certain numbers with some other numbers and multiplication. So if you can do data entry into an Excel sheet, you can do a total, sum, you can do a multiplication and division, you are good to go. If you're not comfortable with an Excel sheet, no problems. All you need is paper, a pencil, and a calculator. The only thing is, this will require a little more effort, but that's not a very big problem. The next requirement is an internet access. And finally, you should have the time to do this work. Once you gain confidence and competence, you'll be quite comfortable doing it on a regular basis because you would like to trim your investments. And as a matter of fact, you can even start your own systematic investment plan or a SIP. And you can save the money of the charges that you pay for a mutual fund. You will be really impressed with the growth that you will be able to acquire, which will be far better than any other mutual fund which is growth oriented and is based on an index. Here is a recap of how you will go about doing your thing. First, make columns and rows for the stocks to be purchased and fill in all these column headings. The first one is stock. Write down the 30 company names. Check out the price of each on the stock exchange web page. On the same page, you will find the free float market cap as was explained in an earlier slide. Calculate the weight. For the total portfolio value, now calculate the investment amount for each one of these stocks. Then you can calculate the number of shares. The total amount to be invested in each stock is divided by the price, and that gives you the number of shares that you have to buy. This may be a fractional number, so you will have to round it off to the nearest significant figure. If it is less than or equal to 0.5, you just take the figure as is shown before the decimal point. If it is more than 0.5, you buy a whole share for it. Simple. I will now show you a real example of a portfolio which I helped one of my friends to make. My friend wanted to invest 27 lakhs 50,000 rupees. That day, the market closed on the 20th of July 2021 when the Sensex was 52,198. After extracting all the data from the BSE website, the free float market cap stood at 58 lakh 4,280 crores. This is the total free float market cap for all the 30 constituents of Sensex that particular day. This is what the spreadsheet looked like for that particular day. Here are the first 10 stocks out of the 30. The first one shown here is Asian Paints. The price at the close of the market that day was 3,159 rupees per share. The free float market cap for this company was 142424 rupees in crores. The total market cap for all the 30 companies together worked out to this figure shown in the fourth column. Now, If I divide the free float market cap of that particular company, that is Asian Paints, by the total market cap, I get the weightage, and that comes to 2.5%, or in a decimal fraction it will be 0.025. My friend's investment target was 27 lakhs and 50,000. If I multiply the weight with the investment, I will come to know how much is to be invested in this particular stock. That value is 67,478 rupees. I divide this number by the price. The price that day at the close of trading was 3159. So the total number of shares which I need to buy to construct this portfolio according to the Bogle's method will be 21.36 shares. Since shares are traded in full numbers, I will buy 21 shares. Like that, if you see Axis Bank, the total number of shares works out to 120.54. Since it is more than decimal 5, I will buy 121 shares of this. So we can go down this list and you can check out the calculations with your own calculator, or simply copy these figures and formulas into your own spreadsheet. Let us now look at the next 10. We continue with the same methodology for the next 10 set of shares. Over here you'll see that Nestle India share is very expensive. The price of that is 17,829 rupees per share. But the weightage is very low. The weightage is only 1.1%, or as a decimal fraction, it is 0.011. So the amount that one needs to invest out of the 27.5 lakh rupees is just 30,000, which translates to 1.69 shares. Since the value is more than decimal 5, I will buy 2 shares of this particular scrip. These are the last 10 set of shares. Mind you, when I say the last 10, these are listed alphabetically, not according to the value or the investment amount. You can stop the video in any one of these 3 spreadsheets and study the figures and follow the instructions that had been given earlier, just to make sure that you understand the process. At this point, you might well be very skeptical, and that is okay, because before you develop confidence and trust in Bogle's methodology, you would like to try it out in a sandbox. Just like children build sandcastles, you too can do the same thing without spending a single paisa. I'll now explain the sandbox to you in the next slide. You can create your sandbox at moneycontrol.com. First, create an account. It is absolutely free and there are no strings attached. There may be some other websites as well, but this one is quite user-friendly. Once you have created an account, locate the Portfolio tab and click. The Portfolio tab is right here. As you can see, your portfolio does not have any balance. You'll have to start by putting in the shares. Scroll down this page and you will come here. This is where you add stock. Locate this on your screen and click to add stocks in your portfolio. This is the screen that will appear next. You put in the stock name and the quantity which you have calculated according to what has been taught earlier. Add more transactions after each one of them till you hit your 30 stock portfolio. Now sit back and monitor how the portfolio behaves every day. Once the market closes, just compare your results with what is to be expected. Once you are convinced about the efficacy of Bogle's magic at work, you will not delay a single day and you'll dive right in. Because if you have a real portfolio, you will be earning the dividends on all the shares as well. And that's around 0.5% of the invested value. Besides, you'll be saving almost 1.75% expense ratio costs. Both these together add up to 2.5% or 25,000 on a 10 lakh portfolio investment. That's just a little over 2,000 rupees a month for work that you will be doing for around an hour and a half to 2 hours at best. And once you have done the initial hard work, all you'll have to do is fine tune it every 6 months. So friends, by now you are completely convinced that this is just the right approach for you to start reaping the returns from the stock market. But maybe you are feeling a bit confused, or you might be too busy or lazy or just too tired. But don't worry, I am there to help you in this situation. So friends, for a small fee, I can help. You can buy a template of the Excel sheet which I have taught you in this particular video lesson. All you have to do is plug in the value of your total portfolio investment. You can then go and buy these shares, or if you have any doubts, you can put it in the sandbox, the money control portfolio, and watch for a few months and convince yourself that this is just the right approach. All that for a small fee of 99 rupees. If you wish to buy the Excel sheet which I mentioned, just drop me a message on WhatsApp on 830-885-1274, or you can send me an email to learnbogle@gmail.com. You will find these two details in the description box below the video. So friends, that brings me to the end of this video. Here's a quick recap of what we learned. We must remember that the stock market beats fixed deposits, gold, and real estate for growth. And always remember the power of compounding. That means it pays if you stay invested. If you follow the index, you will ride the tide and your boat will rise automatically. Don't listen or wait for any expert tips. We also learned about the wonderful man called Jack Bogle, who passed away in 2019 and created the Vanguard mutual fund using the principles which we learned in this video. Vanguard has got more than $7.5 trillion assets under management, which is more than the national GDP of almost every individual country except the United States and China. We also learned two new terms, free float market cap and weightage, and we learned how to use them to our advantage. Next was how to build your portfolio, a step-by-step guide. And then we saw how we can test this portfolio for no cost whatsoever in a sandbox. No costs and no risks. And finally, once you have mastered this technique and gained the confidence by watching the progress of your sandbox, just do it. Don't wait. So friends, with that, I wish you all success in happy investing and growing your wealth. Thank you.